horror stories about people that have not prepared properly for retirement or done complete estate plans. And Alynn's going to share some stories about why you need to be prepared properly for retirement.
Okay. And some of these are things that have happened over the last 10 years, but they're pretty bad. So they're the ones that stick out in my mind. And why I want to talk about them is that a number of Canadians have group plans. So I want to talk about a few blunders that people have made with group plans and then individual financial planning things that people could have done better. So,
all right, tell us the story about the lady that missed contributing to her group plan for 21 years.
Yeah, that one. And that probably was at least 10 years ago, but this lady sticks out in my head huge. I think of this lady all the time because she said her grandfather had worked in a union a number of years ago, and he didn't trust the company that he worked for, and he said never participate in anything that the company gives you.
Oh.
So this woman chose, based on her grandfather's experience, to not contribute to a group plan.
Oh boy.
And her employer would have taken, it was about $5,000 a year, and again, this is about 10 years ago now, would have taken like $5,000 a year off of her check. So she would just do payroll contribution. So yeah, at the beginning she would obviously miss that money, but then they were doing the match. So this woman would have had $10,000 a year going into a retirement plan. But she did not do that for 21 years. And I got off the phone with her and I felt absolutely sick. She was referred to me by a mortgage broker that I know and said, this lady needs to start putting some money away for retirement. And then so I had inquired about, does she have a group plan? And she told me the story. And I thought, oh my goodness.
All of that
Do
money.
the math on that. And we were just pure basic mathematics. $10,000. Okay, $5,000 of her money times 21 years. So there's $105,000. And then your employer matching $105,000. And I don't know what her risk tolerance would have been because I actually didn't take this woman on as a client because I thought, oh my goodness.
Interest accrued on the compound interest of investments, right?
I can't even imagine. But that one stuck out something fierce. I thought, you know what? I hear stories all the time where, someone comes in and says, I don't want to invest in XYZ because this happened to a friend or a coworker. And, everyone's situation is different. But that one, missing out on 21 years of contributions, she just threw out $100,000 of free money from her employer.
Not to count all the money she could have made with her investments.
Exactly.
Yeah,
so that one sticks out huge. So that's the first one.
Okay, so what's the takeaway on that one?
Well, we're going to talk more about group plans. So
right.
So don't be, don't let a bias that somebody else has affect your finances, right?
Because it can cost you hundreds of thousands of dollars.
Yeah, absolutely. That one still, I'm telling you the story. This happened like 10 years ago, and it still sticks out. I think, my goodness, that is a ridiculous amount of money to lose out on.
How about the one about the lady that didn't pay into her pension plan at work for 15 years?
Yeah, there's another one. That one was more recently, I would say within the last year. This lady worked for a company where she worked just as an hourly employee, and then she switched over, and then she was working in management, and she just happens to work for a company where I have a few clients that work at the same place. So she had come in and, can we do your taxes? And I started looking and I said, why aren't you paying into your pension plan? Because I have a few clients that work at the same place. And she looked at me like, what do you mean? And I said, well, you should be paying actually into your company pension plan. I have a monitor in my office. I unplugged, where she could see the screen. I pulled up somebody else's taxes and I said, well, I know somebody that works at the same company as you, similar type of job, and they have a pension adjustment, meaning they have money coming off of their check for over $5,000 a year. So upon further investigation, this lady went to her company and found out that, yes, she missed out on enrolling into the pension plan. So she was as an employee under one pension plan. When she switched over to management, she would have been in a new pension plan. So we don't know if it's HR or what exactly happened, but this woman just made the assumption that she was still in a pension plan. You want to know what happened? The employer went back 1 year, made her she could pay into it, and they accepted the 1 year. She burnt on the 14 years before that.
God.
Yes. horrific. So if you're watching this video and you've worked for a company where maybe you were an hourly employee and your role has changed and you're in management,
yes.
2 different lines that you can look at on your T4 slip. So if you get a T4 slip, you're an employee somewhere, again, whether you're management or whether you're hourly or salary, however your setup is. There's 2 boxes. There's box 20 you want to look at and also box 52. Those are indications that you have some sort of pension going on with the company. So that's a really easy one that will take you 30 seconds. Pull out your old tax return, pull up your T4, and if you're thinking you should have some money being contributed, that would be a great place to start. Or perhaps if you have, say, a group RSP, do you get an actual RSP slip? So again, box 20 or box 52 of your T4, or if you don't have a separate RSP contribution slip, you might want to do some digging, because let me tell you, that was pretty sad, talking to that woman that, losing out on 14 years of paying into a company plan. And somebody probably dropped the ball at some point. And who knows if the HR person at the time was even there. But anyway, this happened about a year ago. So this woman did some investigating, and she's definitely out a sizable amount of money.
I think it's so important to pay attention to what you're signing on for and what the pension plans are and the group plans when you join a company. Because I remember back a long time ago when I worked at the casino, it was basically just all these forms that they put in front of me. And I think I was like maybe 21 or 22 and I had no idea. So this is kind of like signing. Yeah. And in a long time after I'd left the casino, I'd been gone maybe 7 or 8 years. I had gone to do some financial planning work, and they brought up this LIRA thing that I had with the casino. And I'm like, I don't know what that is. What is it? And they're like, it looks like you signed up for some group benefit plan at some point while you were employed. I'm like, yeah, but that was like almost 10 years ago. And they're like, well, it's still in effect, type thing. So I had no idea. And of course, when you're in your early 20s and you're just starting out, I think people just don't know what to look for or the questions to ask.
Absolutely. One of the future blunders we're going to talk about is actually an employee that worked at Caesars. So stay tuned for that. But I just one more thing to wrap up about that lady that I spoke to. The positive is that we do taxes for clients. So don't get me wrong. It's extremely unfortunate that this lady missed out on how many years. But at least we found the problem now. And she's still going to work a few more years, and she can at least get some money in there. Can you imagine this woman, comes to see me 6 months before she's ready to retire, or another financial planner thinks she's entitled to all this money and realizes, I can't retire. So when people come to meet with me, I always ask them, bring just our initial right fit conversation, bring me a copy of your tax return so I can see what you have going on. And that's where I discovered that was in our initial meeting that, what do you mean you have a pension plan? You're not paying into it. And that's where I caught that error.
Wow.
So, scary.
Grab some financial advice. Talk to an expert, somebody in the know when you get a new job. And because I just remember all these forms that were just put in front of me. And I'm like, yep. I had no idea what I was signing my life, signing away on.
That's okay. So. But actually I have a few stories. And one of them is a gentleman that had worked at the casino. And he put his money into what's called a guaranteed interest account.
Okay.
And this is somebody that, this was like 15 years ago. And guaranteed interest accounts would pay like 1 or 2%. So how it works with Caesars Windsor, which is our local casino here, you put money in. So let's say it's 3% of your pay, and then they're going to match it. And that money goes into what's called a defined contribution pension plan. So you choose how the money's invested. The problem is this gentleman was in a fund that really didn't pay anything. So you can imagine cost of living as 3 to 4% a year, and the funds he was in were only paying him 1%. So I said, time out. We're going to take a look. So the only homework on his part is I said, okay, now it's all computerized. This was they weren't as efficient with computers, 15 or so years ago when this happened. Now clients and I have a number of clients that work for our casino here, where we'll actually log in on the computer and see what their mix is of their investments, and we can make changes. Or if they bring in a physical copy of their statement, then we can look. So no, I don't get paid to manage a client's work plan, but my concern is their overall financial health. And, I've had clients, a few people lost their jobs last year because during COVID, they did a lot of downsizing at the casino. And I had a few people that had $200,000 to $250,000 in their group plans. So, when they leave, they need to know what to do with it. So to me, I want to make sure that they're investing money properly, and that could be a pretty big part of your financial plan, your group benefits. So making sure that you're in the optimal fund. So again, that gentleman that was basically making 1% to 2%, that's not very much money.
Not at all.
Yeah. So if you're watching this and you have a financial professional in your life, have they reviewed your work plan? Have they given you advice? Are they making sure that you're in the right plan? Because a lot of these companies with a group plan, you have somebody in Toronto that's managing the funds, but you don't ever see them. So you have no idea. And if that's not your forte, if that's not what you do every day, then you have no idea what's going on. And we're filming this in a time period where the markets are very volatile.
Tariffs on, tariffs off.
Yes.
Tariffs on,
yes.
Tariffs off.
Yes. So, we're filming this we're beginning of May 2025. The markets have been pretty crazy. So if you're considering retiring in the next couple of years and you still have a fairly aggressive portfolio, having a conversation with your group benefits administrator or with your own financial advisor, or if you don't have anyone, give us a call and we'll help you figure that out, because you don't want to find out that your portfolio has gone down 20 or 30%. That could affect when you can retire.
It's so imperative to talk to somebody in the know, especially in this market with the volatility in investments, stock markets, everything's going up, down, almost on a daily basis, it seems like. And a certain somebody who runs the country in the United States can't seem to make up his mind on which direction he's going to go with the economy. And that's just plain craziness with all of our money and all of our investments. So especially now, talk to somebody in the know that's going on, find out where your group plan, what it's doing, where you're investing, what the return on that investment is. It's so important.
That, and while you're pulling out these statements to take a look, double check who you have as your beneficiaries. I can't tell you the number of times that somebody's pulled it out and an ex-spouse is a beneficiary, or somebody that you don't want as the intended beneficiary, because you know what? If that person's named as a beneficiary and you die, they're still getting those funds. So that's another thing. So if you're watching this, you're taking the time to listen and watch this, I would implore you to pull out your statements and take a look and say, is what I'm in, is that still comfortable? Or should I be making some changes?
Right.
So.
All right. Tell us the story of the widow that had $20,000 tax slip that could have been avoided.
Okay. So we're going to switch gears to people that have come to see me for retirement and estate planning, and their previous financial institutions could have done a better job. So I met a gentleman a few months ago. His wife unfortunately passed away, and he came to see me. And again, when people come to see me, I always ask them, can you bring me a copy of last year's tax return, your updated statement, so we can see what you have going on? Well, this gentleman only had about $7,000 or $8,000 in a tax-free savings. His wife had passed away. She did not have a tax-free savings, but he had over $300,000 in non-registered GICs. So he had over a $20,000 T5 slip from his bank that he had to claim interest income on, which that shouldn't have been the case. So when his wife had passed away, she would have had $95,000 of TFSA contribution room. That should have been maxed out. He should have had $95,000 that should have been maxed out. And, they should have had maybe $100,000 in a non-registered GIC, and that would have made the tax slip much less than $20,000.
But again, it's you don't know what you don't know. Right?
However, they deal with a large bank, one of the big 5 banks in Canada. So the problem is that the individual managing the funds for this gentleman did a very poor job. And, to me, it's financial planning 101. Is your TFSA maxed out? If your TFSA isn't maxed out, then somebody that's keeping a larger sum of money in a bank account, because, again, that generates a T5 slip and you have to pay interest income, or if you have money in GICs, max out those tax-free savings first. So with this gentleman, the onus is not on him. Right? This is an 80-year-old man that, owned a business. Makes me sad. Owned a business for years, and he took care of running a business, and then he entrusted his finances with a professional, and they did an extremely poor job.
Because it's in the bank's best interest, literally, to make interest off the money that's
Yes.
invested.
And the other sad thing was that he had a pretty significant amount of money in registered funds, so RSPs that turned into a RIF, and it was just taking the minimum. So he now has a plan. He's now a client of Godfroy Financial. He's realized, I had to be delicate about it because pretty upset. Over time I had to try and explain to him. There's a little bit of a language barrier with him as well too. Just explain that this is what's happened, but we can fix things over time. We got to keep you around for a few more years though. So
right.
the only job on your part, I need you to
Stay
live.
healthy.
I need you to live for another 5 to 10 years so that we can get this money out over time,
right.
and not leave such a big tax burden to your children. But the unfortunate part is that he is entrusted an individual at a large financial institution, and they didn't do the best job. So sometimes it's important to get a second opinion.
Second opinion, very important.
And so we're recording this, what's today, May 2nd?
Yes,
May 2nd.
So 2025.
Yeah, so if you're watching this, you've hopefully done your income tax return for 2024.
I just got mine in.
If not, you're late. Did you have someone good do your income taxes?
Yes.
Oh, awesome. Good. Glad to know you had a great person do your taxes. But something to look at when you're looking at your tax return, look at line 13000, and that's interest income that you'd have to pay. Or if you're looking at all of your slips, if you have a T5 slip from a bank or a credit union or another financial institution, that's an indication that someone's paid you interest income, and you pay the same tax on that money as all of your other income. So sometimes making those shifts and moving the money to a tax-free savings, maybe moving the money to a non-registered account that will pay you dividends and capital gains, you'll pay less tax. So sometimes you can go to a financial advisor, but the financial advisor doesn't always do
tax planning,
the best tax plan for you.
Mm-hmm.
Yeah.
That's what makes you so rare. A financial advisor who's a tax planner as well.
Yeah, exactly.
It's a very rare combination that the listeners out there should be taking advantage of. So if you're paying attention, take advantage of it. All right, tell us about the man making $200,000 plus per year, but didn't have his TSFA maxed out, and the nasty tax slip that came along with it.
Yes. So had a recent meeting with a gentleman. He's trying to figure out, can I retire? Have I put away enough money? He's in his mid-50s, but he could live for another 40 years. So he wants to make sure with the funds he's put away. And so he brought me a really nice spreadsheet, which I love spreadsheets, not to sound like a nerd, but he was very organized, which I like. And I mean, if you're not organized, that's okay too. We help you get organized if you're not. But the thing that stuck out the most for me is, we have a husband and wife where combined between the two of them, less than $20,000 in tax-free savings accounts, a large sum of money in a non-registered GIC.
Oh boy.
Which is going to generate a large tax slip,
bill. Yeah.
Which is going to happen for their 2025 tax return because the GIC is just coming up for renewal now. I said, well, we're going to do some planning, but the fact that your incomes, and the crazy thing is the income is just in the husband's name. He makes about $200,000 a year, and the wife makes less than $30,000. So I said, okay, well, time out here. The GIC is going to come due, and your interest income is going to be almost $30,000. You're going to have to add $30,000 of income on top of the $200,000 that you're already making. So you're already just at the 50% tax bracket. So now we're going to put $30,000 more on top of that. And you're going to be paying 50% tax. So, okay, great, the bank is paying you $30,000, but you're going to give half of that to the government. A few things that could be avoided. And again, this is somebody that deals with a large financial institution, has a financial advisor, came to me for a second opinion because there are a couple little things that have happened. He's like, I don't know if the individual I'm dealing with right now is the right person to help me get through, get me to retirement and help me with the plan. So a lot of times people come to see us for a second opinion. And I said, well, there's a few little blunders here. Your TFSA, you should not have that amount of money locked up where it's not liquid, right? Emergencies happen, life happens.
Accessibility.
So maxing out both yours and your wife's tax-free savings, that's first and foremost. And if you really wanted to do a non-registered account, why wouldn't you put your wife's name on it? You've been married for 30 years and you own a home together and properties. At least if you owned it jointly, then that almost $30,000 of interest income, she can put half on her tax return and pay at a much lower tax rate, and you put half on your tax return. So just some very basic financial planning things that somebody that's what's the proper word? Just a proficient, adequate financial advisor should be able to do.
Right.
So it's small, but this gentleman,
Well done.
and he felt embarrassed. And I said, time out. Like, the onus is not on you.
Right.
There is a professional that's, taking courses, that just hasn't done the proper planning for you. It's not your fault. This gentleman's, he's in a skilled trade where I'm not allowed to hang up picture frames at my office. I'm not good with a hammer and a nail. I can't imagine trying to do, this gentleman's an electrician, has, I'm sure, a difficult job. I can plug things into the wall. That's it. I don't touch anything electrical. That is not my forte. So I say, I'm like, I wouldn't even attempt to try and do your job. So that's okay. That's why you have people that specialize. The unfortunate part is that there's somebody that should be doing what's in this gentleman's best interest. And I don't know if it's a lack of knowledge or what the issue is. Right. But at the end of the day, I've uncovered a few areas where I can definitely help this gentleman and his wife and help them be on the right track so that they can retire. So the whole point of us doing these podcasts is, I say all the time, you don't know what you don't know.
Yes.
So just taking a closer look at your own investments, and yes, you might have a financial professional and you think that they're competent and you think they're doing a good job. Sometimes there's little tweaks that can be made. So sometimes a fresh set of eyes can really make a world of difference.
Okay, so let's kind of switch topics a little bit here. In dealing with a financial professional that may be working with a large chain bank, what would be the questions that a client could ask to ensure that they're getting the best service? What would be a question that, as a client walking in to speak with a financial representative from a bank, to ensure that they are getting on the right track to retirement?
I would ask them, can you have an actual written retirement plan? A lot of times people come to see me, they have, a lot of RSPs, a lot of tax-free savings, but they don't have a clear articulated written plan. So I think having a plan, if you have investments, if you have a tax-free savings that isn't maxed out, looking and saying, okay, are you carrying a larger sum of money as a balance in your bank account? Can you shift that money? Do you have a non-registered or open account? Can you be adding to that? We talked at the beginning about group plans. Asking your professional at the bank, I have a group plan. Could you take a look and let me know, based on my risk tolerance, am I in the right funds? Right. I think a lot of them, due to compliance issues, are probably not going to be able to answer those questions for you. But I think each individual bank has their own rules. But I think you want to look and say, okay, is this person going to be the one? We've had this conversation before about, people can help you accumulate your money and get you to the top of the mountain. But then when you're at this peak where it's like, okay, I've worked all these years, I've amassed this wealth. How am I going to get down the other side of the mountain? How am I going to take money out, not unnecessarily pay too much tax, live and enjoy myself? What does that look like? Is that professional still the right person to help you do that?
Yeah, you might be working with one person that might be able to get you to the top of that mountain as far as savings and investments, but are they the right person to be able to help you deaccumulate your assets? Yeah. That's something I've learned being with Alynn for a long time, because nobody ever tells you that. And I repeat this like all the time to people I talk to about finances. Nobody ever tells you that at some point you need to start taking that money out. Exactly. Or it's going to bite you in the butt.
Yeah. So being efficient about it.
Yeah. So deaccumulation's so important, and it's something that nobody talks about.
Yes.
Like my entire time growing up, it was always about savings, RRSPs, investments, savings, RRSPs, investments. But nobody ever looked at me and said, at some point you're going to have to take that money out because it could bite you in the rear end when it comes to taxes when you're retiring.
And just working with someone that's a specialist. So a lot of financial planners are generalists, and I was a generalist for a number of years, right? Someone came in, they wanted to talk to me about saving for a house, great. Or they needed to have some life insurance to, cover their family if something happened to them, do some savings for retirement, talk about estate planning. And it wasn't until a few years ago where I said, okay, this is a space that I really want to work in and specialize in. The clients that I'm working with are retired or are within 5 to 10 years of retirement. That's a space I really want to work in. And I've had clients come in and say, I have a 25-year-old living at home. They're trying to save for a house. Will you work with them? And I politely say, I won't, because that's not the space that I'm working in right now, but I do have a younger advisor in my office, and that's who she's spending her time working with. So I think the key is looking and saying, okay, as the person that you're working with, are they going to be specializing in this area? This is going to be a whole new chapter in your life that you're going to have to deal with. That's where I'm spending my time now.
So remind us again, what are the 5 designations that you have that makes you a specialist, and why should it matter to people?
Okay, so I have my CFP, Certified Financial Planning designation. That's probably the most recognized designation across the world. I have my Certified Life Underwriter designation, and that's an advanced tax planning designation to help people that are trying to it helps with some business owners, more complex income tax cases, if somebody wants to leave money to charities. So that definitely helped me a lot there. I have my EPC, Elder Planning Counselor designation, so it's working with the 50 plus demographic. I have my Master Financial Advisor designation, specializing in pensions and benefits, so that, people that have pension plans, helping them with the deaccumulation of getting money out of registered plans. And the last one is Certified Executive Advisor. So basically, when somebody passes away, there's up to 17 professionals you may have to deal with: accountant, lawyer,
real estate people.
Yeah, so just helping so that when somebody does pass away, just making things a little bit easier for their family, hopefully helping them to not have to pay as much in probate fees. Those are the 5 designations I have.
Sounds like you're the complete package, and definitely a retirement specialist, like from charity planning all the way to executive planning and dealing with all the professionals when somebody dies. Wow. Pretty impressive. Very well done.
Yeah.
All right, so I'm looking at this list of stories that you gave me, and there's 2 that are not on here that I remember you telling me.
Okay.
So the ones that I want to touch upon and see if you remember them, and you let me know, was the one where you got the government to pay back $20,000.
Oh.
Which I think is a great story.
Yes. So like I said, when there's a lady that I know, she's a friend of a friend, and she said, I love my in-laws. They weren't born in Canada. Sometimes language can be a barrier, but I feel like there's something off with their plan and their finances. Can I bring them in, and can you give me a second opinion? So they get the standard, bring me your tax return, bring me your investment statements. And so they brought in their tax return, and we live in Windsor, Ontario, which is the automotive capital of Canada. And this gentleman had retired from Chrysler, and a lot of times Chrysler will offer a buyout as an incentive for somebody to retire. And so what happened was this gentleman had taken a $50,000 buyout. However, the person that prepared the income taxes neglected to put the RSP contribution slip on his return. So on his last T4, yes. So on his last T4, his income was higher because Chrysler gave him the money as an eligible retiring allowance. There's eligible and non-eligible retiring allowances. So he had a retiring allowance. However, the tax preparer missed putting the RSP contribution, which is, to me, mind-boggling. To me, it's pretty, I don't understand
Basic
how it was
101.
missed. Anyway, so this man ended up thinking he owed $20,000 to the government, refinanced his house to get some money out, because he didn't have he had registered funds, but he didn't have that $20,000 available to pay the tax.
Let me just pull out my credit card. Here's the $20,000.
Yeah. So it took about 2 months to get this fixed up. It took me a little bit to figure out. Well, it didn't actually. It took me a few minutes to figure out there, and I went, holy cow, how do I tell these people that their family friend that did their taxes buggered it up really bad?
Wow.
And then they paid all the fees, and so it was a little delicate situation. Long story short, that was probably 2 or 3 years ago now. Long story short, I do their taxes. They were just in actually 2 weeks ago. Oh my God, these people hug me. They bring me candies. They bring me things that will rot my kids' teeth. I don't even bring them. They're like so appreciative that I was able to fix it. So they're always bringing me little treats and things for my son.
In a nutshell, the government ended up having to pay back that $20,000 to these people.
Yes.
And that's what makes it an awesome story. How many stories do you ever hear where the ending is the government paid you money?
Yes.
That never happens.
Right. But it should have happened in the first place.
Yes, exactly.
But it was an error of but we're all human, and
people make
professionals
mistakes.
make mistakes.
Yes.
Thankfully, they came to the right professional to fix it. And my goodness, these people were absolutely ecstatic. And I have clients. I have clients for life now because I was able to fix it for
Well,
them.
20K mistake is a pretty big mistake.
That is a very big mistake. It's just, I just think before, because they're the nicest people, and I think, my goodness, they would have had to refinance their house, go to a lawyer, pay all these extra fees and things. Like, what is that punch? But anyway, that was one I fixed. What's the other one?
The other one is the two kids while they were in their mid 20s or 30s whose mom died, and you had to tell them. This is relevant because so many people can find themselves in this situation, which could be completely avoided.
Yes. I tell this story a lot. I have clients of mine, they have a friend, and they were telling her, you got to see Alynn. Anyway, long story short, she never did come to see me. But this lady passed away. She had some health issues going on, but she passed away somewhat unexpectedly, and here she had her 2 grown children in their early 30s, and of course they went to mom's best friend. What do we do? And they said, okay, you're going to see Alynn. Helped them do her final tax return. The unfortunate part, obviously, is that the woman died, but the really unfortunate part about the situation was that she had worked for the city of Windsor, and she had an OMERS pension, and she died in October. And I say this a lot, and it's horrible to say, but the later in the year somebody dies, the worse it is. So she had OMERS income. It was, I think, just under 50,000 or so that she had made. This happened a few years ago, but like, this is one of those ones where it just, makes me sick when I think about the story and how it all kind of went for this family. And then the mom had taken Canada Pension, so we added on Canada Pension. The problem is she had a couple $100,000 in RSPs, and she was divorced, and her kids were grown up, so the money couldn't be rolled over. So when we did mom's final tax return, we had OMERS, Canada Pension, and then we had to tack over $200,000 of RSP income onto her final tax return. And I had to tell these poor kids that were trying to clean up mom's house and get it ready to sell that they also had to cut a check to the CRA for $100,000 to pay her tax bill.
So on top of dealing with the grief of losing their mother and then taking care of all of her household stuff, you're now delivering the news that, hey, you owe the CRA over $100K.
And I'm not a kick someone while they're down person, but I thought, my goodness, if this woman would have come to see me 4 years before, when she started taking her CPP and getting her OMERS payment, I would have had her start taking a little bit out of her RSP and shifting it to her tax-free savings, because thankfully mom had a will, and the kids signed a form for me to be her authorized tax preparer when she passed away. Her TFSA was not maxed out.
Oh, wow.
So, and she had been retired for 4 years. So there was a 4-year window where the person that was managing her funds at a bank should have said, and I'm not saying she would have taken out a lot, but maybe it was $5,000 or $10,000 a year. Take out, pay the tax man, and shift it to a TFSA, back to the deaccumulation of assets.
So important, deaccumulation of assets.
You can imagine how upsetting it was, because this woman's best friend has been a client of mine for years. So, she was pretty upset about losing her friend. Here you have these, young adults that lost their mom.
Yes.
And man, so there were some tears that day. That's why that one really, gets me, because I thought, oh my God, if this, and I didn't say it to them, but I'm thinking in my head, my goodness, if your mom would have just come to see me when, she was referred to me, and then, she didn't, life happens. And a lot of that, a million different things could have happened, but at least if we could have gotten $5,000 or $10,000 a year out, had her pay the tax on it while she was living, shift it to a TFSA, then it wouldn't have been as big a tax burden on the family.
The importance of proper retirement planning.
Absolutely.
And having everything in order. Thankfully, she had a will.
Yes.
I'm sure you have stories of people.
That's a whole other podcast. We got. That's a whole other podcast we'll do when people don't have wills and the mess.
Yeah, and like a proper estate planning, because I'm sure it can get pretty ugly between family members.
I could talk for hours on that one. Yep. There's another topic for us.
So, all right. So in looking and going through all of these kind of retirement horror stories, what would you say would be the top 3 things that people need to prep to kind of avoid situations like this? From what I'm hearing from you and listening to, I think maxing out your TSFA would probably be amongst the number one thing.
Yeah, absolutely that. If you have a group plan, reviewing it regularly, right. Not just, hey, I got my statement in, you get one, for the end of June and the end of December, checking in on it periodically and making sure that, you have the proper beneficiaries designated, and then based on what's going on in the markets, that you're still in the proper funds. And if you have a group plan, making sure that you actually have your funds going into it, right? So we told a couple of stories where people weren't actually paying into a plan when they were eligible for it. And the other thing actually is, I've known a few people. I mean, the first story we told was a lady that didn't pay into a pension plan for 21 years, but I've had a few clients come in, but they've worked at a company for a year or two and they still haven't put money into a plan. So sometimes they'll give you these big books and they look daunting. Ask your HR professional at your place of employment or ask a financial advisor. Yes, they're not getting paid to help manage those funds, but they should be concerned about your overall financial health. So
And
don't leave that money on the table.
that's the key.
Yeah.
They should be concerned about your overall financial health.
Yes.
And sometimes that's not the case. It's
Right.
about bottom line, making money.
Yeah.
So I think it's, I don't know, like basically to recap would be like max out TSFA, make sure your group plan, and what would the third thing be, do you think?
Check for those interest income slips. So if you get a big tax slip from one of your financial institutions, know why you're getting the slip. Just better educate yourself.
Right.
You know, is there something that you could be doing? Could you be shifting money into a different investment vehicle to cut down on that tax bill? Because it's something that's, if you put money in there, it's probably going to be happening to you every single year.
Right.
So over time, that can really add up to a lot of extra tax dollars you could be unnecessarily paying.
And always look into deaccumulations of assets when you're nearing retirement. I think that's so incredibly important. Something, again, that I never learned.
Yeah, and have a solid plan.
Yes, have a solid plan in
Yeah.
place for it. So hopefully you got something out of this. Maybe you have a horror story that you'd like to share or know somebody. And the reason why we're sharing these stories is an attempt to educate people to avoid these situations moving forward. And I mean, if you're like 5 to 10 years away from retirement, like listen to these tips, listen to these advice, and make sure that you don't find yourself in a situation where this can happen to you. So I'm Glenn Picaro. This is Alynn Godfroy, the financial architect for Canadians. And if you have any questions, please leave them down in the comments. We will do our best to try to address anything that you have, any questions, comments, or concerns. I hope this brought a lot of information and a lot of good tips to help you prepare for retirement. And any last thoughts as we say goodbye?
What's the one thing we say? If you fail to plan, you plan to fail.
Exactly.
So take a few minutes and
Very good.